Welcome back to The Note and welcome from the floor of the New York Stock Exchange, where the election of Donald Trump has triggered a rally which few expected but many have enjoyed. Animal spirits are back. Now you can see that both in the performance of the main indices, all of which have hit an all-time high since Donald Trump was elected. You can see in particular small stocks have rallied. That's a big change from the pattern. Bank stocks have rallied in a big change from what we've been used to. Meanwhile, bonds have sold off quite aggressively, and so have foreign stocks, because people don't like Donald Trump's America First rhetoric.
Everybody thought, so they sold. Before the election, we had two downdrafts preceding the election, which were selling panics, had all the characteristics of liquidation out of fear. And on election night, we had a third one, took place outside of the U.S., didn't see it in U.S. markets, but it was on U.S. securities. Dow was off 900 points at the worst. So the sellers were exhausted. The short sellers had sold short. There wasn't anybody left to sell. Trump wins. Up goes the market because everybody now has to run to cover and change their position. That's why we had the rally.
Now, of course, the big questions now are how long can this go on and how far can it go? People like to draw comparisons with Ronald Reagan, another right-wing outsider who came to Washington and cut taxes. He, of course, presided over a big stock market boom. The problem with that analogy is that the markets themselves could scarcely be more different. Back then, stocks were historically cheap, if you judged by cyclical earnings, while bonds were also historically cheap. Now it's completely the other way around. Bonds are as expensive as they've ever been, and stocks are also very expensive. That makes it very hard, if not impossible, to replicate Reagan. Perhaps a better analogy might be 1951, when you had an era of wartime limits on bond yields finally being lifted, very similar to what we're seeing now. And that coincided with the beginning of a much longer, steadier bull market in stocks. But again, the problem even there is that stocks started that rally much cheaper than they are now. Now the big question is why? Before the election, the markets gave every impression of being very scared of Donald Trump. But it appears once he was actually elected, they stopped thinking about his personality, started thinking about his policies, and saw that there was a lot there for markets to like. In particular, he seems to favor Keynesian infrastructure spending, a big program of deregulation of many sectors, and perhaps most importantly, tax cuts for corporations. If they happen, all of those are things that stock markets will like.
I believe what we're seeing out there in the marketplace is more and more folks are starting to ask questions about what Trump's economic policy will be. Getting folks to really think through, well, what does it actually mean if so-and-so is on the Treasury? What does it actually mean if the Department of Commerce is run by so-and-so? And I think a lot of those policies that these new characters that hadn't really been discussed before the election will bring to the table are not yet being priced into the markets. And so my prediction is that we're going into a holiday season. People won't really fully understand what's going to happen until the new year. And I think what we're going to start seeing what the market thinks after the inauguration.
In the long run, there's a lot of reasons to worry. This rally has started with stocks already very expensive and with rates very low and ready to rise. Beyond that, people are conveniently forgetting a lot of things they don't like about the Trump platform, such as his trade policy. And in any case, we've still got huge uncertainty about what he's actually going to do in office. But for now, Christmas is coming, animal spirits are back, tax cuts give an exciting reason to buy stocks, and any professional investors will need a lot of courage to stay out of the market.